Whether it's learning about earnings estimates, exploring the Zacks rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. You know, by far the most frequently asked question by Zacks customers is, what is the difference between our two stock rating systems, the Zacks rank and the Zacks recommendation? So, who better than Steve Reitmeister to bring in to explain this to us? See how we knew that? Called you right up and said, Steve, why don't you come down and talk about this?
And here I am.
And here you are. So, what is the difference?
Yeah. In a nutshell, the Zacks rank is a short-term stock rating system, so people who want to aggressively trade stocks in like a 1 to 3 month time horizon, the Zacks rank is most potent for that person. The person who's a little more of a buy and hold investor or looking out at least 6 months, but let's say a year or more into the future, that form of investor would want to use the Zacks recommendation.
Okay, so one is for short-term trading, the other for longer-term investing.
Yes.
That part of it makes sense. Some insight, if you would, on how these two systems were created.
Right. The Zacks rank we've gone over in depth here, and we have a lot of videos in the Zacks rank guide, so I'm going to go in the very brief here. But the Zacks the Zacks rank is what we're most famous for, and that's the quantitative stock picking model that Len Zacks created to harness the power of earnings estimates and earnings surprises. So he has 4 factors that the computer model updates every night and gives a stock rating in between 1 and 5. 1 being a strong buy, and working down the list, a 2 a buy, 3 hold, 4 sell, and 5 strong sell. And here again, to get more in depth in that model, lots of resources on the website.
Right.
The Zacks recommendation starts with the Zacks rank, okay, but it's trying to employ it over a longer time period. So here again, still trying to harness earnings estimates, but trying to see how to do this over a longer period of time. So Len created a second quantitative model to use this information, but the thing that makes this model truly unique is that we have a team of 50 analysts who follow the industries, talk to the company management and vendors and so on, and they have insight into the firm that goes beyond the quantitative system. So we allow them to override the system on occasion, when they see fit. And so the recommendation is a blend of the quantitative model and what our analysts are saying. Just quickly, I forgot to say, one other thing is it's only a 3-point scale. So instead of the Zacks rank, which is 5 points, 1 through 5, it's just 3. It's just buy, hold, sell. There's not a strong buy or a strong sell signal.
All right. Interesting enough, but why do we allow those analysts to override the system?
Yeah, why do we allow? That's a great question. I know the first question that people are saying, well, if the model's good, why override it? And the thing is, analysts do have insight that is worth tapping into, in particular things such as valuation or momentum. So let me just give a quick example here. You could imagine that buying Google at $80 per share, and they just kept having earnings surprise after earnings surprise, and estimates going up. It was a Zacks rank, Zacks #1 rank for a long period of time. But when you start pushing up towards $700 per share and all this profit is made, and maybe the valuation's getting a little bit stretched, so the Zacks rank could be a #1. But the recommendation, you could understand why an analyst would say, you know what, going from 80 to 700 is pretty good. Let's take some money off the table and maybe move back to a hold for the long-term outlook. But the Zacks rank may still be saying Zacks rank 1. The most important part of this is we let the analysts override the quantitative recommendation because it works. We have done studies of when they have overridden the signals. They have beaten the model when they have done that. So it was in our best interest and an investor's best interest to let them do that. Let me put up on the screen here the performance of the Zacks recommendation. Here again, we talk so much about the Zacks rank and going back to 1988. This model's been in place since 2003, and here again, it's a long-term rating system. It has done phenomenally well. On the bar chart form of this table here, the light green is the performance of the Zacks recommendations of buys, and the gray is the S&P 500. For each time period, 2003 through the current year, our Zacks recommendations of buys have beaten the market, and actually quite handily. And at the very bottom, that bottom row tries to show the percentage difference that we have beaten it every year. And going back to 2003, we beat it by 47%. So it is a model that has stood up very well, and why we feel comfortable saying we have a great model but analysts overriding it still pays off very well.
Let me play devil's advocate here just for a minute, and this
Okay.
is where I get to have a little fun, so bear with me if you would. And again, what do I know? But, you know, most investment firms have only one recommendation out
Yes.
there and one recommendation system. Why do we feel that it's appropriate to have two?
Yeah, you know, the Zacks rank was the only system that we had for a long period of time. However, not everyone's a trader. Not everyone wants to just buy stocks for 1 to 3 month time horizon. So there was there was a lot of requests from both our institutional clients and individual investors. Is there something I can do for my longer term holdings? You know, so I could have like my nest egg money in the way I want to invest that, and then, you know, the Zacks rank for my trading account. So Len took a look at it, and here again, being the mathematician that he is, he tested different models to see how he could use earnings estimates and the Zacks rank, but harness that power over a longer period of time. And that's where we get that underlying model. So here again, different types of investors. If you're short-term aggressive trading, the Zacks rank is the model for you. If you're more of a buy and hold investor and trying to find stocks that you can hit more home runs with, you know, because the Zacks rank is about, you know, a lot of singles, you know, hit more home runs with a rating system over longer term. That's what the Zacks recommendation is for.
All right, what about this? What about the person who really doesn't have a preferred investing style yet, and they just want to use the stock rating with the highest rate of return?
Yeah.
Which rating model should they go to?
Yeah, a lot of folks that are in that camp, and we certainly understand that. So here again, if you have a preferred style, now you know what to do, okay, Zacks rank versus the recommendation. But if you don't have a style, I would send people in the direction of using the Zacks rank. The funny thing is the performance numbers in between the Zacks rank and the Zacks recommendation since 2003 are almost dead even. The Zacks rank has a very small 3% advantage. But the reason why I would go with the Zacks rank is because we know, going back to 1988, going back over a longer period of time, more up markets, more down markets, more sideways markets, how it has held up. And also we have, I think, better tools to narrow down the list of the Zacks #1 ranked stocks. So there's 220 stocks, which is too many for anybody to handle, to narrow down those lists and get a handful of stocks that may even outperform that 30% annualized return that we keep talking about for the #1 ranked stocks. So for the person who doesn't have a style or preferred style, I'd say go in the direction of the Zacks rank. In particular, we have an education series called the Zacks Method for Trading. I would take a look into that as a DVD series that explains how to trade the Zacks rank and do it very effectively. I would go in that direction.
One more question. Seems like, go away, kid, you bother
I thought it was
me
done now. Okay.
Can the stock rating systems, these two that we're talking about here, ever contradict each other? For example, Zacks recommendation of a buy and a Zacks rank of a hold, or even sell. If so, then what should an investor do if there's some contradictory signals?
When you think back to how I said that the two are created, okay, the one purpose being short-term and one purpose being long-term, you can understand how they could be in contradiction. And so let me simplify this. They're not in contradiction if you're only using one system, and that's what we're trying to tell people. Pick one system. You want to be short-term, use Zacks rank. You want to be long-term, use the Zacks recommendation. You're not quite sure, use the Zacks rank, okay, and only look at the one signal. But the reason why a stock could be a Zacks recommendation of buy, and I mean long-term buy, short-term sell, is because the fundamentals of a stock that may do well over a long period of time are terrific. But here again, the Zacks rank is so sensitive and changing every day. If the earnings estimates, and here again we're talking now about like Zacks rank, you know, the master's level course, but you know that this idea of the 60-day window of time that it looks at earnings estimates. A stock, a very attractive stock, can fall back to a Zacks rank of 3, which is a hold, and yet still we feel very confident it could do well over a long period of time. So yes, they can say different things, but if you're just concentrating on the one that suits how you want to go to market, then there is no contradiction. You will not be confused about how to apply it.
All right, well there you have it, in a nutshell, as they say, the difference between the Zacks rank and the Zacks recommendation. Hope that helps answer your question. With Steve Reitmeister, I'm Terry Ruffalo.